Hello, my name is Dylan, and I'm joined today by Joe, John, Jonathan, and John, and representing North Dakota State University. Today, we'll be discussing our analysis of biotechnology. We issue a sell recommendation with a target price of $104, representing a 34% downside. This recommendation is based on three primary pillars: double-edge M&A, premium valuation, and declining return metrics.
Biotechnology creates equipment that analyzes DNA and proteins in order to recommend proteins for the doctors. They're broken down into two segments: protein sciences, which is broken down, which represents 78% of revenue, and diagnostics and genomics, which represents 22%. Under these two segments, there are multiple companies which create synergies within the company. Biotechnology has over 300,000 products, and we wanted to highlight some of the key ones. The analytical division creates ELISA kits, which detect and measure antibodies in the blood. Exosome DX, which is a part of the genomics division, creates non-invasive liquid biopsy tests for prostate and lung cancer. And finally, Simple Western, made by Protein Simple, lets you separate and analyze proteins in under a few short hours, compared to doing this process by hand, which normally takes days and is prone to human error. Since 2014, Biotechnology has acquired 15 companies, some of which have helped expand their segments and divisions, as well as geographically through their products. M&A can be a double-edged sword, meaning it can have high growth or it can be very detrimental to their company, creating risk transference or excessive debt. After conducting analysis of biotechnology, we found three key growth drivers: geographic expansion in China and India, mergers and acquisitions that create synergies within the company, and lastly, their products, such as biopsy tests and the automated Western blot, which uses 80% less protein compared to their competitors.
China has a crucial importance when it comes to revenue growth in the life science technology industry. It has emerged as the second largest market for most companies after the US in 2018, and demand is growing 10 to 20% depending on product category. It is the fastest growing market in the life science technology industry. In the first two quarters of the fiscal year 2019, Biotechnology realized a 30% organic growth in China, while other demographics grew in the low teens and high single digits. The life science technology is estimated to be worth just under $400 billion. This industry's stock rose 21% in 2018 and generated products and services of more than $100 billion in annual revenue. Growth rates in the biopharma end markets continue to generate high single to double-digit growth. Some key growth drivers were strategic M&A, backlog gains, geographic expansion, and new product mix in 2018, and is expected to continue into 2019.
We found 5 main competitors for Biotechnology. However, we consider Thermo Fisher, Bio-Rad, and Bruker to be more significant than the others. Thermo Fisher is the largest competitor in the space with $24 billion in annual revenue. They produce similar products such as analytical instruments in addition to flasks and pipettes. Each of the competitors chosen compete well with specific segments of biotechnology. Moving along to financial analysis, we'd like to highlight some of the key differences in Biotechnology's historic multiples relative to the company's peers. To start, the EV to EBITDA multiple shows that investors are paying 28 times EBITDA, which is much higher than the peer median of 17 times. Further, the company's 10-year EBITDA growth lags greatly behind that of their competitors with a difference of 82%. The PE ratio leads us to believe that investors are being too optimistic about the future growth of the company. This is because they are taking into account recent acquisitions and further, we believe that the investment, supporting our investment thesis of the company is overvalued.
We see Biotechnology's debt-to-equity ratio appropriate relative to their peers, and currently we don't see any issues based on liquidity. This leads us to believe that the company isn't in any financially dangerous position. When looking at return metrics, we've seen return metrics be cut in half since 2010, from low 20s to high single digits. We attribute this largely to Biotechnology's aggressive M&A strategy. Though we begin to see these return metrics rebounding in 2017, we don't see them returning to prior highs.
Geographic expansion has been and will continue to be a driver of growth for biotechnology. In the past 5 years, China's grown at a 26% CAGR, EMEA at a 17% CAGR, and APAC at a 10% CAGR. Relative to other companies in the space, revenue from China makes up a small portion of biotechnology's total revenue. We expect further expansion and aggressive growth in China in the coming 5 years. We also expect more growth in APAC, specifically India, as they strengthen their foothold in the region. When valuing biotechnology, we looked at three different methods: DCF, multiples, and precedent transaction. We weighted multiples at 50% because multiples are the most accurate way to value a company with unpredictable cash flows, such as biotechnology. We weighted precedent transaction at 25% due to the acquisitiveness of the life science sector. And we value DCF at 25% as it is a standard in the industry.
Now, when looking at past companies to compare biotechnology to, we included a criteria of a $2 billion market cap, give or take, was in the healthcare equipment sector, and at least 10 companies to compare them to. We then got a median EV to EBITDA multiple of 16.81 to receive an intrinsic value of $99, representing a 38% downside. They are currently trading at a higher multiple to their past peers and have not shown the evidence to justify them trading at this high. Now, when comparing biotech to their competitors today, they are currently at a notably higher EV to EBITDA multiple compared to their peers, as well as even a more significantly higher EV to revenue multiple compared to their competitors. Therefore, we use the EV to EBITDA multiple because it was closer related relative to competitor median. Then, by using the multiple of 17.75, we received an intrinsic value of $104, representing a 34% downside. They are currently trading at a significantly higher multiple to their peers, and we believe this helps support our thesis that they are currently overvalued according to this valuation.
When projecting our DCF, we calculated a WACC of 9.5% and a terminal growth of 4%. While this terminal growth is fairly aggressive, it's made up of a mix between U.S. growth, China, and the rest of the world, and it further supports our overvalued weight. We projected revenue to grow at 14% CAGR over the next 5 years. This growth mainly coming from three divisions: reagent solutions and their reagent products, analytical solutions and automated Western blot, and the genomics division of liquid biopsy prostate cancer tests. We projected margins to expand slightly over the next 5 years. This slight increase is due to a favorable product mix in the analytical solutions and genomics divisions. They have higher overall margins than the company, and as they become a larger portion of revenue, we will see margins begin to expand. And lastly, we projected free cash flow to grow at 16% CAGR over the next 5 years.
Charles Cummeth has been the company's CEO since 2013. We found Mr. Cummeth to be in the 69th percentile of total compensation relative to the company's peers. To find this, we believe that CEO compensation as a percentage of revenue is a better metric to use when analyzing CEO compensation. And after completing this analysis, we believe Mr. Cummeth's total compensation is relatively appropriate. Although this did not play a significant role in our valuation, we did find it important to take into consideration. In addition, we'd like to note that 4 of the 5 executives at Biotechnology have previously worked at Thermo Fisher, one of Biotechnology's largest competitors.
We identify standards imposed by regulation agencies, such as the FDA, as a potential risk that could impact biotechnology. Additionally, we'd like to shed light on the economic volatility that comes with operations in environments outside of the U.S. and a general demand decline in the biomedical industry. Transitioning now to concerns, we look at Biotechnology's most recent acquisition, ExosomeDX. ExosomeDX has yet to be declared NCCN and Medicare eligible due to its involvement in lab operations and liquid biopsies, something we believe to be outside of Biotechnology's core competency. It's unknown at this point if or when ExosomeDX will be approved. Now we look at antibiotic resistance. This stems from the fact that the overuse of antibiotics could result in cell immunity and therefore unsafe fluids for lab use. And finally, we look at Biotechnology's aggressive M&A strategy, which can be likened to the double-edged sword M&A analogy mentioned earlier.
In conclusion, we view Biotechnology as a company with an unstable business model and spotty growth potential that is dependent on a successful acquisition. It is currently overvalued according to our DCF and multiple valuation, and has not shown us the evidence to justify it trading at this premium, leading us to our sell recommendation. We'd like to thank the CFA Society for putting on this event, as well as our advisors and mentors. We will now open the floor to questions.
Hi, I'm Lindsay Strickland with RBC Wealth Management. So my question relates to the management team and the proxy statement. So were you able to look at the proxy statement to see what metrics management is focused on for their bonuses so that we could align our expectations with those metrics?
Thank you for your question. So there's short-term incentives and long-term incentives. To start, short-term incentives are split, or is an annual cash incentive plan that is paid out on the basis of each division's net sales, in addition to organic revenue and operating income. In fiscal year 2018, the successful completion of these goals resulted in cash bonuses paid out in 87.4% to 161.3% of base salary. Long-term incentives are split at 50% time-based awards and 50% performance vesting awards. These, similarly to short-term incentives, these are based off of organic revenue and operating income. These are paid out at a 3-year cliff-based equity award style if these goals are met.
Thank you. And then on the revenue recognition, can you speak a little bit about that and how the company essentially gets paid, whether it's through consumables or through instrumentation, subscriptions, recurring revenue, that kind of thing?
Can you repeat the question?
The question is on revenue recognition and essentially how the company gets paid. So do they get paid by selling the consumables or the instruments or through a subscription model or recurring revenue? Just a little bit more color around how they make money.
Yep. So executives are paid on organic revenue, so it's coming all internally, which protects investors from any executive compensation being skewed from all their acquisitions, as well as each division's net sales.
I
Sorry, it was about the company.
So I think you might be a little confused. So they're paid by products, they're consumables. They sell whether it's their products, so they have over 300,000 products. A vast majority of these are reagents, and so they have a good amount of repeat sales because when these reagents are used up, they need to order more. I'm not going to go into the chemistry of it. Then they have a lot of lab science equipment that they sell to laboratories. And so, yeah, the majority of their sales are from consumables.
Julie Gray with Columbia Threadneedle. You touched on it in your presentation, but can you expand more, or maybe go back to the slide on what's driving such strong growth in China?
Yeah, so as far as China goes, demand is growing 10 to 20% depending on product category, and they become the second largest market for most companies after the US in 2018. Some of this demand is that the Chinese government has a higher demand for the biopharma products. This going forward, we believe that Bio-Techne will have to be watching this carefully, because if they don't find themselves, them in China have a sort of a mix-up or feelings don't go well, I guess, or relationships are kind of ruined, they might find themselves out of one of the fastest growing markets and one of the biggest.
And how do you expect the ongoing tariff discussion to impact this company?
Yeah, so tariffs have actually minimally affected Bio-Techne. The government likes Bio-Techne's products, and therefore they're not going to raise tariffs on something they're already getting at a lower price. So they've been minimally affected, and however, it is important to keep watching it going forward. Like I said, China is one of the fastest emerging markets, and it'll have to be watched carefully going forward how these can affect them.
Could you guys be a little bit more specific on what exactly are their competitive advantages in a competitive marketplace? And then also, what exactly is the value that they're providing to their customers?
Yep, so their competitive advantages, the strongest one is going to be their product breadth. So they offer more reagent products than other companies. And then also their Western blot. So lots of other companies produce Western blot. Theirs is a little different. Every company is slightly different. Theirs in particular is known for displaying data better than others and using less proteins, which makes overall running the Western blot cheaper. And that's pretty much the only competitive advantage that we found them to have.
Over the last few years, the company's profit margins have gone down as they've made these acquisitions. How much of that would you attribute to temporary issues like restructuring and integration, and how much of that might be a permanent reset to a lower profit business model?
Profit going down is mainly due to M&A, and we believe it'll rebound slightly going based off our DCF projections, but we don't see it going much higher. Part of their higher ROS in the past was positive interest payments, which we don't see returning, so we see it basically peaking around 7-8%.
Clem Lau from Untitled Capital. So just curious if AdCam based in the UK is one of the competitors? And if yes, what are the strengths and weaknesses of Bio-Techne
What was the company?
over AdCam?
Abcam?
Mhm.
Yeah, I suppose we don't know enough about that. We've heard about them, but we didn't do too much research, so going forward, that would have to be looked into somehow.
Got it. And then just on free cash flow margin, looks like consensus is expecting roughly 15% for the current fiscal year. That compares to around 20 to 30% in the past 3 to 5 years. Do you expect that to be a temporary thing or more structural?
Free cash flow expansion, we expect to continue into the future. Most of this is based off the higher margins that are coming from the two divisions that are going to grow a lot, analytical solutions and genomics. So we expect it to growth to continue in the future, but not go higher than about 2 or 2%.
You highlighted that the exosome product is awaiting Medicare approval. What is your view of if that happens and when it happens, and how have you flowed that through your forecast for the company?
Yep, so we're not sure exactly when it's going to happen. Basically, in our DCF projections, we made the assumption that it would happen. But to adjust for the risk involved with it, we had our growth much lower than what management projects and what analysts have in mind. So we put a little lower to adjust for them getting exosome approved. If it does, we could see much higher growth, or if it doesn't, it would definitely hit the company.
And obviously this company has done a lot of acquisitions. It's been a key part of their strategy. Do you know what they've paid for these acquisitions on a multiple basis and whether or not they've ever made mistakes with the strategy?
Yeah, so their strategy is to acquire companies while they're relatively small, generally around the $5 million payment, which in the grand scheme of things isn't really significant. Their goodwill has gone up considerably, so we believe that they are overpaying for these companies. However, goodwill is not a useful metric until there is an impairment. However, we do expect to keep watching that more closely going forward. What was the second half of your question, or did I answer it?
Have they made mistakes?
Have they made mistakes? I guess going forward, we can't say yes or no they have made mistakes, but according to their return metrics and how we believe personally the market is overhyping these acquisitions, and we have not yet seen the earnings compared to like their competitors, for example, who are also highly have a lot of acquisitions as well. They have not generated as high earnings, free cash flow, and we don't believe that going forward. We need to see better increasing return metrics and margins going up in order for us to agree that these acquisitions have been helpful.
So just a little bit of follow-on, and you touched on some of it there, but in your analysis of the 13 or so plus acquisitions that they've done, have you found that they've actually created, the acquisitions have actually created shareholder value?
Yeah. I think it has created shareholder value. They have been adding these assets to their business, therefore increasing the company's overall portfolio. So I do think it has helped shareholders. However, we just don't believe these acquisitions have been as helpful as maybe forecasted by management. And going forward, we'd like to see increasing return metrics as well as margins to justify them trading at these premium multiples.
I'll add to that real quick. Essentially, when we spoke with management, they said it'd take about 2 to 3 years, possibly more, for us to see returns from their acquisitions. So, over the next 3 or 4 years, we'll start to see whether their acquisitions have actually paid off and created shareholder value. It does take time. It's not right away.
Given your sell recommendation, on the other side, what would you say is the single strongest talking point for someone who might put a buy on the stock?
I think the biggest strong point on someone that might be looking for a buy is on the flip side of their acquisition strategy. If they can get Exosome DX, both NCCN and Medicare approved, and have successful acquisitions going forward, we'll see return metrics go up and better returns from the company.
All right, thanks a lot.